Welcome to Markets Now. I'm Michelle Rook, along with Arlan Suderman with StoneX Group, and we had a higher day in everything. Arlan, let's talk a little bit about soybeans, which were kind of the leader in the grain complex. A lot of it has been kind of predicated on weather and the bullish anticipation coming up in the report tomorrow, right?
Yeah, it really is. When USDA slashes 4 million acres from the soybean crop, it's got to find a way to make that balance sheet work. And that means less demand for the coming year. And the problem grows even more if we see a below trend yield. And right now, the odds are that we will see a below trend yield because of the stress that we put on the crop back in June. So USDA's got to cut demand. I do expect them to cut a little bit more from exports for this year. That'll give a little larger ending stocks estimate for the next year, although I think we'll see them cut the size of last year's crop on September 30th, which is another negative to supply for the soybean side. And after getting lower than expected stocks reports in both March and in June, I think the writing's on the wall now for that to happen. So where do they cut demand from? They're probably going to want to do it from crush. I don't think they understand the scope of the new construction we have coming online, a new crush capacity that has a vested interest in proving itself to investors and staying in force and operating near full capacity. But it's exports that really need to be cut. And I think China has given us the freedom to do that. China's been aggressively buying up stocks from Brazil. In fact, if you look at the first week of July shipments from Brazil, they're almost half of what they shipped in all of July of last year, just in the first week of this month. That gives you an idea of how aggressively they continue to ship. And we estimate that spring and summer, really late spring and summer shipments into China, imports into China, exceed what they've crushed and will crush the rest of the summer by about 12 million metric tons. So that's 12 million metric tons that China will have, that they've been able to increase their reserves by the end of the summer, that they can then draw on rather than buying as many beans from the United States this fall, which is our aggressive shipping time. So I do believe there is room to cut exports without having to take prices a lot higher. But the biggest reason to take prices, maintain a high level of price, is to keep them in the green for Brazilian producers. Brazilian producers were in the red with the recent price drop. I'm talking about the late spring, early summer price drop in soybean prices. They were only planning on expanding soybean acreages next year less than 1%. They normally increase 4 to 5% per year. And so this is now incentivizing them to relook at things and to expand acreage. That's part of the job of the market right now, is to expand acreage again this coming year to make up for the lost acreage in the United States.
Let's talk about the corn market. The big wild card here is if USDA lowers yield. The last time they did it was 2012. What's the justification that USDA has here to lower yield in the report tomorrow?
Yeah, ordinarily I wouldn't expect them to do so. They look at 3 criteria on adjusting it in July, and that would be planting pace. So planting pace was a little faster than normal. They look at temperature. Temperatures were hotter in some areas, colder in some areas, but overall average very similar to normal. And they look at rainfall. And rainfall was below normal, but I don't think enough to make them go ahead and make that reduction in the July report. But the thing that I think is going to throw them over the edge in making the decision is the extra 2 million acres of corn on an already bloated balance sheet. And they have a tendency to kind of solve for the desired answer. And I don't think they want to print something close to 3 billion bushel carryover for next year. So I think that'll give them kind of the excuse they're looking for to go ahead and reduce yield in this report. I'm looking for a 177 yield. I feel pretty good about that as a former agronomist as well for where we sit right now. My yield model is actually lower at about 171.7 right now, but I expect that to kind of be climbing up in the weeks ahead. But overall, it's very difficult for me to be bullish corn. We may have a rally here and there, but longer term, USDA is currently overstating demand. They may overstate it even more in this report in order to try to make their balance sheet work. But I think in order to do that, they also need to cut yield.
Yeah, even if they cut it 4.5 bushels, as you suggest, that is still going to be a very bearish balance sheet no matter how you cut it, isn't it?
It really is. We're looking at 2 billion bushel plus
Yeah.
balance sheet, depending on what you do with your demand estimates. And I think USDA is probably going to maintain these relatively high demand estimates for at least another 4 to 6 months before they're forced to start to lower them. But new crop export sales are very sluggish right now, and eventually that's where they're going to have to see the biggest cuts.
Gotcha. What about wheat? Was it a follower today? Has it been a follower of corn and soybeans on the recent uptick here, or is it trading some of its own fundamentals, including some of these crop concerns? I mean, lower crop ratings on spring wheat. We've got harvest is behind pace.
Well, we saw some tailwinds in all the commodity sector because of expectations that the CPI numbers this week are going to come in low enough to give the Fed the permission to pivot. We saw some better than expected Chinese economic data that created some tailwinds for commodities. But then you add to that the fact that the Ukraine grain initiative looks like it's going to come to an end early next week. That supported Chicago. But look at Minneapolis wheat ratings, spring wheat ratings, continuing to be low. We've never had a trend yield when we've had ratings this low at this time of year. So we're looking at a smaller spring wheat crop. That provided also support for hard red winter wheat. So Chicago getting support from the grain initiative coming to an end in all likelihood. Uh, hard red wheat's getting support from the lower crop ratings, and also looking for more abandonment to come and start to show up in the hard red winter wheat acreage because of the weather problems we had this year. USDA really hasn't cut harvested acreage yet, and I think that still has to happen.
Gotcha. Cattle market update here to Dave and feeders with a little bit stronger corn market, and we made new contract highs in the back months of the live cattle futures. So what do you think? Are we ready to take the next leg up? And if we start to continue to see these prices go up, will cash continue to follow, or will it pull it?
Yeah, this market has been much more resilient than I think many anticipated, and that's been because the cash market's been much more resilient. Packers are expected to kind of continue to try to control the chain speed. Even as we looked at last week's slaughter, it came in lower than what was anticipated, certainly much about better than 8% slower than last week's holiday trade, and one of the lowest holiday weeks that we've seen in a long time, but the numbers aren't there. But we're looking at choice cuts of really the product market really falling off. We are seeing some rationing of demand. The question is it enough? And when you look at the demand for these cattle versus the supply, it would suggest that maybe it isn't enough yet, that the market still does have some more work to do.
Yeah, is this supply situation tighter than 2014-15 to the point that we get a much longer tail than we had that cycle?
Yeah, I think we may see it play out that way. And keep in mind, we really haven't seen the big drop in number of head in the feedlots yet as heifers get retained. And that's really the next step we're watching for, is when we see those placements really drop off because of heifer retention to try to rebuild the cow herd. That's the next step in really tightening up those meat supplies.
And we'll end with hogs here. We had a $25-$30 run off the contract lows up into July 1st with Prop 12 kind of pushing us along there and some demand. But it has extended now past that point in time. Did you anticipate it was going to keep going here? And how much more does it have in it?
Yeah, it's had more staying power than what I anticipated. And that's largely been because we've seen stronger demand than what we expected. Last week's export data showing record exports for the month. We didn't think that we would see that after we saw the African swine fever surge in demand into China. Mexico's been a huge part of that. As we look at product, it's really going out the door now at a much faster than expected pace, and especially the hams. And that would suggest that export business to Mexico. China's even been buying some in there as well. China's starting to release reserve supplies. Their returns aren't good on feeding hogs, but they're still reducing numbers. You say, then why in the world are they importing? And really, it comes down to they're seeing soft demand as well. A lot of problems, but fortunately, our hog industry is benefiting now primarily for two things: strong demand into Mexico and a consumer moving down the value chain from beef to pork. And we just have to eat more bacon, and we can get kind of all the supplies more in line, because the other cuts are pretty well falling in line now.
Yeah. Thanks for joining us, Arlan Suderman with StoneX Group. And that is Markets Now.